This high growth company that I'll be sharing with you today is someone that makes money when companies list on its exchange. It also makes money when people trade more stocks, especially from China. And it also makes more money when more international investors are looking to invest in China.
I would also say that there is now a return of interest quite strongly from investors around the world wanting to look at opportunities, especially in the mainland China and the rest of Asia, and I think we're benefiting from that. We've seen in the generative AI space a lot of very exciting technologies coming out from the mainland China. I think has led a lot of people to take a real serious look again at the Chinese economy and the prospects.
Who is this company? I shall not hold it back. It's none other than Hong Kong Exchange. For today's case study, I'll be sharing with you two key drivers of its growth, and towards the end, I will also be sharing with you why it's possibly still undervalued. So if you're keen to find out, continue watching. Hi guys, welcome back. Without further ado, let me share with you the first thing to note, which is Hong Kong right now boasts the largest IPO market in first half 2025. Hong Kong has actually beaten all other capital markets, including US, for IPOs in first half 2025. And there were 42 listings just in 6 months, up 40% year on year. If I'm not wrong, the number of listings in Singapore has to be less than 5. Total funds raised stood at the highest since 2021, crushing the 87.6 billion Hong Kong dollars for the total of 2024. Is this a sign of revival for the Chinese market? I sure hope so. And if it really is true, Hong Kong Exchange definitely is a key beneficiary. So let's look further at the listing data. This screenshot directly from Hong Kong Exchange shows that currently there are 2,329 companies on its main board. Actually, when I was doing research, the entire website was very user-friendly. The presentation was also very easy to read. It gives me a lot more confidence also investing in Hong Kong listed companies. But back to the main story. Moving forward are the new IPO applications, correct? Just now we discussed 42 for first half of the year. But what is in the pipeline right now sits at 168 new applications acknowledged in 2025. Wow. It just means that more and more companies are trying to list right now in Hong Kong, taking advantage of this good wave up simply because there was a pent-up demand over the last few years. When markets are poor, you go and list, nobody wants to buy. Right now, there could be pent-up demand from the last few years. That's why there's so much listing. Without needing to guess further, it's quite obviously that Hong Kong Exchange needs to do something with that pent-up demand, correct? And capitalize on it. That's why they've actually unveiled fast-track IPO processes for eligible Chinese mainland firms to streamline the IPO application. Under this new framework, eligible A-share companies with mean market cap of 10 Hong Kong billion dollars can get their accelerated IPO done, and the review period can be just up to 30 days only. So why do these companies want a dual listing in Hong Kong?
Close to 60 of them are waiting in the pipeline. I think a big reason for them pursuing this A then H IPO is the fact that many of them have international ambitions. So many of them, given their international footprint, they will have employees all around the world, and therefore having Hong Kong listed stock as a form of remuneration for their employees is also very attractive.
There are many A-share companies like Guizhou Moutai that can definitely do a list in Hong Kong, but there's one company that's actually taken this leap forward. It's none other than CATL. CATL is actually the world's largest electric battery supplier for the 8th straight year, and they have a 38% global market share. They are in front of BYD in terms of being a lithium battery supplier. CATL has actually announced to list on Hong Kong Exchange in May, and their IPO only took 128 days to complete. But that's not the end of the sweet story. If we look in terms of share price chart, you realize the blue line over there is the Hong Kong listed version. The yellow line is the China A share. What we can see is that the same thing is now priced at 30% premium, which is actually a difference between the blue and the yellow line. Take note again, both of these stocks are not fungible, which means the yellow line is really by international investors. It's also why many have mentioned that CATL has indeed brought back interest to China, just like the DeepSeek moment. So it's not like back in 2022, 2023, where people were scared of China, because now the listing in Hong Kong can be easily accessed globally, and investors are buying great companies like CATL and giving it a premium. With the success of CATL, I think there are other large cap China companies they will be itching also to list on Hong Kong, correct? Again, with more listing means more revenue. That's the first key driver, and that's still not even the biggest revenue pie. This is the second segment. Daily trading on Hong Kong Exchange has been surging up year on year. Let's look at its first quarter results. You realize that there are 5 portions of revenue, correct? And half of it comes from cash trading, which in simple terms, when people do stock trading on Hong Kong Exchange, it falls into this revenue pie. Hong Kong itself is attractive to international investors, and they have also a Hong Kong Shenzhen Connect that allows for trades to flow into Shenzhen and vice versa. The one which I boxed up in yellow is the true shining light. Southbound Stock Connect saw a record quarterly average daily trading up 255% year on year. That simply means a lot of Chinese investors are pouring money towards Hong Kong side, buying stocks listed over there. And as you can guess, there is a lot of money in China that can flow down. This is not the peak, but in my opinion, the tip of the iceberg. And if you want to dive deeper onto the breakdowns of the cash trading segment, this shows where money is made. On the left hand side, cash segment, you'll see trading fees and trading tariffs, clearing and settlement fees. Both of these have jumped up year on year, which allowed cash segment to jump 15%. At this moment, there's also another interesting pie that's delivered a good year-on-year performance. It's actually coming from the London Metals Exchange, which falls under the commodities segment. Recently, they've raised rates over there, and I was thinking, London Metal Exchange, does it mean that it's trading gold? Because gold is an all-time high, correct? So when I curiously went and looked into that, I realized that the biggest revenue component is actually around base metals, such as copper, aluminium, and zinc. Not specifically into gold, although they have some exposure there. Gold, as you can see, is primarily traded on London OTC, US COMEX, and Shanghai Gold Exchange, not London Metals Exchange. But if aluminium price stays strong, and if copper price continues to surge up to all-time high, it is likely that London's Metal Exchange will continue to bring profits to Hong Kong Exchange. Next segment, I'll be sharing with you why Hong Kong Exchange, in my eyes, is still undervalued. And before we get there, help me smash the like button. It's taken our team hours to prepare this presentation for you, and I'm filming this late at night. So if you appreciate the hard work, smash the like button, show your support, and thank you very much for doing so. Let me now start by justifying why, in terms of price-link ratio, Hong Kong Exchange actually looks cheap. This is a 5-year comparison. You will realize that price-link ratio was once crazy at about 67 times back in the good heydays of 2020-2021. Actually, revenue for Hong Kong Exchange did not crash in the periods between 2021 to 2024. But stock price actually came down. That's why price-link ratio chart, as you can see, trended downwards. Currently today, it's about 38 times and it's still at fair value for such an outstanding company. Again, Hong Kong Exchange has monopoly over listings in Hong Kong, similar to Singapore. But everything I've indicated to you suggests that it's a lot more vibrant over there. Just like I mentioned, revenue did not collapse. This chart shows the journey when it ran to its peak, as well as the last few years, which was hard for Chinese equities. Let's focus on the top dark blue revenue line. The peak was in first quarter 2021, correct? And then it trended downwards a little bit. And it was stuck below that peak for 4 years. But recently, it has broken that peak and grown to all-time highs. As of this time of filming, this is the second quarter clocking a new all-time high, and is why it caught my attention. I think it's time for a mindset change. China is no longer a very scary place to invest. I think the appetite for Chinese equities is back. We're likely still ahead of the curve, and Q2 could really crack the 7 billion revenue mark. Another point is to compare between Hong Kong Exchange and Singapore Exchange. Singapore Exchange has done record earnings itself, even though listings are nowhere as strong as Hong Kong Exchange. EPS for SGX is right now at all-time high 49.2 cents at the top right. And that is the reason why SGX has rallied 80 to 90% over the last few years. That is the yellow line that's outperforming. Hong Kong Exchange, as you can see, is playing catch up only recently. The 5-year performance gap is so big, and everything I've indicated in today's tutorial suggests Hong Kong Exchange sees a lot more listing, sees a lot more money flowing directly from China, resulting in better trading volume, sees a lot more international investors also pumping monies there. And this effect is just starting only. All these are reasons why I rate Hong Kong Exchange as a top growth stock in 2025. Let me know in the comment sections whether you agree or not, and as always, the ticker for it is 0388. Check it out, see if you like it or not, and as always, check out this previous video I have, which is something I've secretly been buying also. Without giving away, let me invite you there too. Take care as always, invest safely, goodbye.